When we talk about smart beta ETFs, we're normally speaking about funds that track a particular subsector of the stock market, but smart beta is also coming to bonds. BlackRock is starting two smart beta debt ETFs. They started them last week. So here to talk us through them is Rachel Evans. She's an ETF reporter for Bloomberg News. So there are some debt funds that already exist, but it's much smaller than stocks. So tell us about these two funds that were launched.
So BlackRock came out with these two smart beta bond ETFs last week. We have high yield defensive bond ETF, which has the ticker HYDB, and then we also have an investment grade enhanced bond ETF, IGEB. So what these funds are doing is that they're taking an idea that we're more familiar with in the stock market, value and quality, and then applying that to the debt market. So the high yield defensive bond ETF, as the name suggests, is kind of going down a defensive route. So we're looking at bonds that maybe are slightly less risky than perhaps in the broader HYG ETF that BlackRock also runs and is market cap weighted. On the other side, we have IGEB, which is really looking at the return portion of that. So they're looking at bonds that are perhaps higher yielding than maybe would be in something like LQD, which is BlackRock's investment grade market cap weighted ETF.
Now, as we know, typically with ETFs generally, the differences between them can be hair's breadth, right, to try to sort of distinguish themselves. So how do these funds compare to some of the funds that are already on the market?
Well, first, one of the really interesting things about these funds is how they compare to BlackRock's stable of ETFs. So BlackRock has more than 300 ETFs in the US already, and these are the first ETFs that really go with self-indexing, i.e. BlackRock has actually come up with the index themselves rather than paying an external index provider to come up with the index. Now that means BlackRock has all of the control over the process from the beginning to the end. So they come up with the universe, they come up with the methodology, they do all the rebalancing. But it also means that there's a cost saving there. They're not having to pay an external index provider for their intellectual capital. Now that means that when you look at how these ETFs compare to some of the others in the market, they're cheaper than some of their peers. And what's really interesting about this is that if BlackRock comes out more frequently with self-index products, rather than this being a one-time foray into that space, we could see some greater fee compression within the smart beta complex.
Now, as I'm sure you know, Eric Balchunas, who comes in here all the time, says that low fee is really what is driving the single greatest factor driving traffic, driving volumes in the ETF world right now. So are these new funds gaining traction partially as a result of that lower fee structure?
So it's interesting, with these particular two funds, we don't really have a gauge of that yet. They have about 10 million in assets each, but they only launched last week, so it's hard to say how they're doing. But in terms of the space as a whole, we have about 540 billion of assets in bond ETFs overall. 500 billion-ish of that is in market cap weighted. So it's still a very small section of the market that's either smart beta or actively managed ETFs. However, if you go and talk to an ETF issuer, the next big thing from their perspective is often smart beta bond ETFs. We haven't really seen that in the flows yet, and even in the terms of the ETFs being launched at the moment, it's kind of a split between sort of market cap, smart beta, and active. There isn't really kind of one of them dominating. If anything, active looks like it's kind of getting a little bit more traction than smart beta.
Oh, interesting.